All right, let's get right into it. We are going to break down one of the most powerful concepts in trading, how to navigate price. See, the market isn't just a random walk. It has a very clear logical rhythm. It's on a constant journey, moving from being on sale to being way overpriced and then all the way back again. Understanding this flow is everything. Hey everyone, and welcome to AI Explains ICT. In this video, we're diving deep into the core content from month 5, episode 15. I'm telling you, this is some foundational stuff that really forms the backbone of this whole model, so you're definitely going to want to grab a pen and paper for this one. So here's what we've got on tap. First, we're going to decode the market's internal compass, this core logic of premium and discount. Then we'll get into identifying the exact zones institutions are watching. After that, we'll talk about why a multi-timeframe view is a complete game changer, walk through an absolutely massive 1200 pip trade, and finally, wrap it all up with the number one rule, the hierarchy of timeframes. So, what's the real engine that drives price movement? Well, it's a constant, relentless search for value. Price is always, and I mean always, moving between being undervalued, which we call a discount, and being overvalued, which we call a premium. This isn't just a neat idea. It's the fundamental logic behind all institutional order flow. This slide really simplifies the market's main job. Think about it. When price trades down into a deep discount, basically when an asset goes on sale, the algorithm's main objective flips. Its new mission is to seek out higher prices and reprice the asset towards a premium. This is the zone where institutions are looking to load up. They buy at a discount. And of course, it works the other way too. When price rallies up into a premium zone, it's considered expensive. The market's objective flips again. Now it's programmed to seek out lower prices and find value back down in a discount area. This is where those same institutions look to sell. It's just this beautiful, perpetual cycle of repricing. So what about that sweet spot right in the middle? Well, that's what we call equilibrium. It's the 50% level of any given range. Think of it as fair value. Now from here, price can really expand in either direction. So how in the world do we know which way it's likely to go? That, my friends, is where the bigger picture, the market structure on the higher timeframes, comes in to give us our directional bias. Okay, so we get the big picture. Price moves between premium and discount. But how do we pinpoint the specific levels where it's most likely to react? To do that, we need to introduce a crucial part of the toolkit, PD arrays. PD arrays, which stands for premium and discount arrays, are these very specific recurring price patterns that basically scream institutional money was here. Think of them as the footprints left behind by the smart money. These are not your grandpa's random support and resistance lines. They are high-probability signposts for where price is being engineered to go next. And this is our toolkit of PD arrays. We're on the hunt for patterns like order blocks, which are those critical candles right before a big explosive move, or fair value gaps, which show us clear imbalances in the market. We use these, along with breakers, old highs and lows, to really map out the price action. The goal is simple, right? We're looking for bullish arrays in a discount to buy and bearish arrays in a premium to sell. Now we've got our tools, but a toolbox is totally useless if you don't have a map. And this is why a multi-timeframe perspective is absolutely non-negotiable. You have to start your analysis from the top down. It's the only way to understand the real story the market is telling and to establish your overall directional bias. It's a simple 3-step process. First up, the monthly chart. This is where we define our macro playground, the biggest premium and the deepest discount. Then we drop down to the weekly chart to zoom in and find the key PD arrays and objectives that live inside that big monthly range. And only then, finally, do we use the daily chart for one thing, execution, finding those precise entries that line up with the big story the monthly and weekly charts have already told us. Theory is one thing, but seeing it all come together in the real world, that's where the magic happens. So we're going to walk through a monster trade on the dollar/yen, applying these exact concepts to map out a journey of over 1,200 pips. First things first, we're on the monthly chart for the dollar/yen. Step 1 is simply to frame our playground. We identify the significant long-term high and the long-term low. Just by doing that, we've now defined the boundaries between our macro premium and discount zones for this entire analysis. Now, I want you to look closely at the bottom of this range, deep in that discount territory. What do you see? Right there, those 2 consecutive down candles. That is a monthly bullish order block. It's a classic PD array, and it's basically a giant flashing sign telling us this is a high probability area where institutions are likely to step in and buy. And look, price came right down to this 99.00 level and found massive support. Okay, so if we know where the big money is buying in a discount, where in the world are they aiming for? For that answer, we drop down to the weekly chart to find our target. And would you look at that? It is crystal clear. A perfect bearish order block way up here near the 11,1800 level. It's the last up candle before that major down move. This is a high probability premium level that price will be drawn to like a magnet. And here is the result. I mean, just look at that methodical, powerful move. Price launched from our monthly discount order block and traveled all the way up, almost to the exact pip, to hit our predefined weekly premium objective. This wasn't a guess. This wasn't luck. It was a logical, engineered progression from an area of value to an area of excess. That trade was absolutely textbook, but it teaches us the single most important lesson of all. The one concept that, if you truly get it, will change how you see the charts forever. And that is the hierarchy of timeframes. So here's a question I am sure every single trader has screamed at their screen in frustration. Why does price sometimes hit what looks like a perfect, obvious support level and then just completely blow right through it, stopping you out for a loss? We've all been there. The answer is so simple, but it is incredibly profound. A higher timeframe PD array will always, and I mean always, have more gravitational pull than a lower timeframe one. The market's real objective is dictated by the monthly and the weekly charts, not the noise on the daily or the hourly. Let's zoom back into our example, but this time on the daily chart. During this period, you can see price came down and clearly broke below what looked like a perfectly valid daily bullish order block. A lot of traders would have bought there, put their stop right below it, and gotten completely run over. From a daily-only perspective, this looks like a bearish breakdown. It looks like the market is collapsing. But the second we zoom out, the real story snaps into focus. That breakdown on the daily chart wasn't bearish at all. It was a precise, surgical move designed to do one thing: tap into a much more significant weekly bullish order block. The algorithm completely ignored the daily level because its true objective was a more powerful higher timeframe zone. This is the hierarchy in action. And this really drives the point home. I'm going to read a quote directly from ICT because it sums this up perfectly. The daily isn't going to support a monthly retracement. By having the monthly PDAs on your charts, you'll probably see much clearer where they're trying to push price. The higher time frame provides the context that turns what looks like chaos into crystal clear logic. So, the next time you see price crash through a level that looks so obvious, just ask yourself, what story is the higher time frame telling? Making that shift in perspective, well, that's the key. If you found this breakdown helpful, please do us a favor and hit the like button and subscribe to the channel. And if you have any questions, drop them in the comments below. A human will get back to you. Until next time, safe trading.